For decades, there's been one simple, powerful strategy for building wealth. Buy an S&P 500 index fund and just wait. It's a strategy that has literally created millions of millionaires. But what if the very thing that made it so powerful is now its greatest weakness? Okay, let's dive into why the rise of artificial intelligence is forcing a complete rethink of this legendary investment playbook. And this isn't just some theory. That quote comes from an investor who made a fortune with this exact strategy. You see, the beauty of the S&P 500 index fund was always its simplicity. You automatically owned a tiny piece of the 500 biggest companies in America. So if a few failed, hey, it didn't really matter. You were diversified, you were protected, and you just grew with the market. It was the golden rule of passive investing. But, well, that rule is being broken. You know that old idea of being safely diversified across 500 companies? This slide shows why that's just not the reality anymore. Today, for every single dollar you put into an S&P 500 fund, a staggering 40 cents goes to just 10 companies. I mean, think about that. 40% of your diversified investment is actually concentrated in a tiny handful of stocks. That completely changes the risk you're taking on, whether you know it or not. So how did we get here, right? How did the safest, most diversified fund on the planet effectively become a massive, concentrated bet on just a few key players? Well, the answer lies in how the fund is built and the one technology that is completely warping the entire market. All right, so here they are, the new top 10. Just take a second and look at this list. Now, if we set aside the financial giants for a moment, Berkshire Hathaway and JP Morgan, a really powerful pattern just jumps right out at you. What do Nvidia, Microsoft, Apple, Alphabet, Amazon, what do they all have in common? They are all betting their entire futures on one thing: artificial intelligence. So the mechanism behind this is something called a market cap weighted index. It's actually pretty simple. The bigger and more valuable a company gets, the bigger its slice of the index becomes. But this creates a powerful self-reinforcing cycle. As the AI hype drives up the stock prices of these giants, they automatically attract more of your investment from index funds, which, you guessed it, drives their prices even higher, giving them an even bigger share. It's a feedback loop where the winners just keep winning bigger and bigger. Now, you might be thinking, well, can't we just invest differently? And you can. There's this thing called an equal weighted fund, where every single company gets the same tiny slice of the pie. The problem? It follows what's called a negative momentum strategy. That's a fancy way of saying as soon as a company like Tesla starts to take off, the fund automatically sells its winners to buy more of the losers, just to keep everything balanced. All that buying and selling just drives up costs and fees, which can really eat into your returns over time. This heavy concentration in the S&P 500 points to a second and maybe even bigger risk: putting all of your eggs in one country's basket. I mean, for the last 15 years or so, the US market has been the undisputed champion. But history tells us a very clear story: that leadership is never, ever permanent. And this slide just illustrates the point perfectly. In 1900, the United Kingdom was the world's economic superpower. They made up a quarter of the entire global stock market. Investing anywhere else seemed foolish. Okay, fast forward to 1989, and it was Japan's turn, an incredible 45% of the global market. At the time, betting against Japan felt insane. And yet, in both cases, the dominant power eventually faded. The only certainty, it seems, is uncertainty. And by focusing only on the S&P 500, just look at the incredible companies you're missing out on. We're talking about global titans in semiconductors, electronics, cars, healthcare. These are companies that are driving massive innovation and growth. They are simply excluded because of where their headquarters are, not because of their quality or their potential. Okay, so if the big AI giants in the S&P 500 are getting a little bit overcrowded, where else can you look? Well, this leads us to our third big strategic shift, and honestly, it's a bit counterintuitive. The biggest opportunities might not be where everyone is looking, but in what we can call the neglected zone. When it comes to AI, there are really two main ways you can invest. On one side, you have the giants, Nvidia, Google, Microsoft. They're spending billions to build the most powerful AI engine. It's a crowded, super expensive race. But on the other side, you have smaller, nimbler companies who aren't building the engine, they're just putting that engine in their car to win the race. Think about a small logistics company using an AI platform to optimize its delivery routes, saving millions. They don't need to build a large language model, they just need to rent access to one and apply it brilliantly to solve a real-world problem. And this right here is the core idea. Think of it like a price war at the gas station. Once all the big AI models like ChatGPT, Gemini, and Claude are all good enough, the main factor for users becomes price.
The value then flows away from the companies that built the technology and toward those nimble companies that use it in the most clever and cost-effective way. That's where the untapped opportunity really is.
Look, any great technological leap doesn't just create opportunity. It also creates instability. It changes power dynamics, it changes currencies, and it changes trust in the entire system. And what that means is that a modern portfolio needs a defensive hedge, something to protect it when things get volatile.
And you don't have to take my word for it. Just look at what the biggest financial players in the world are doing. Central banks, especially China, are buying gold at a record pace. For years, their purchases were pretty steady, but recently they've accelerated dramatically. This is a huge move to hedge against instability and diversify away from the US dollar.
And this isn't just speculation. There's a major regulatory tailwind here. A recent agreement known as Basel III has officially reclassified gold as a Tier 1 asset. Now, what that means in plain English is that major banks can now treat physical gold the same way they treat cash on their balance sheets. It's a huge shift that makes gold a safer, more attractive asset for major institutions, which in turn drives up demand. The other key defensive asset is simply cash. And if you need proof, just look at what arguably the world's greatest investor, Warren Buffett, is doing. He is stockpiling cash at a record rate. Why would he do that? Because in a volatile or overpriced market, cash gives you two incredible things: safety from a downturn and the firepower to buy amazing assets at a huge discount when everyone else is panicking. Okay, so we've covered a lot of ground. We've talked about an overconcentrated S&P 500, the need for global diversification, the hidden AI opportunities, and the importance of hedging your bets. So let's put all of these pieces together into a clear, updated playbook for this new era. So here they are, the 5 key strategic shifts. First, you have to acknowledge and reduce your overconcentration in the top of the S&P 500. Second, diversify into global markets to avoid betting on just one country. Third, look for those opportunities in smaller companies that are expertly using AI, not just building it. Fourth, add a strategic hedge with an asset like gold. And fifth, increase your cash reserves to protect yourself and be ready for whatever opportunities come your way. And all of this brings us to the final, most crucial question you should be asking yourself. The strategy that worked like a charm for the last 35 years was built for a completely different world. In an age of AI-driven concentration and massive global shifts, simply praying the past repeats itself, well, that might just be the riskiest strategy of all.